Yes, yes, yes. So we are ready to introduce the ZTA Algo Trading Portfolios. Man, it's truly an exciting time. So here we have a fully diversified algo portfolio across multiple instruments, multiple strategy types, and time frames. And the whole entire goal here, as you might have heard me talk about in previous clips and previous videos, is that you really want to see yourself as your own mini hedge fund. The goal of every algo trader should be to grow and to build out a portfolio of robust individual algos that, when placed together in a portfolio, really surpass and can really beat buy and hold. And the idea here is to offer these tools to retail traders who really have not historically had access to these tools. When you think about 10 years ago, for example, the school of retail traders, these tools weren't available to us to use like algo trading software and to like hook up to your broker and to make automated trades. These were kind of like black box tools that you had to either know a guy who knew a guy, or you had to kind of be in the know some way, somehow, with a hedge fund or the more traditional Wall Street institutions in order to have access to tools like these, right? And so the power of, seeing how quickly technology can grow and advance, the fact that these tools are now in the hands of everyday folks like you and I is truly incredible. You know what I mean? It's truly remarkable, and it's a fantastic time to be alive, and it's a fantastic time to be a trader. Okay, so main question from our readers and our customers and our clients is often, why portfolios, right? Like, why can't I just trade one? Why can't you make a single holy grail algo that trades across all time frame? It trades all instruments. It can trade forex, it can trade futures, it can trade crypto. It works on NinjaTrader, it works on TradingView. Believe it or not, many people think that algos should work like this. And you have charlatans in the industry, and you have crooks and thieves who are marketing tools that purportedly work like this. And they tell folks that our algorithm works on any time frame, on any instrument. And I'm sitting here and you're seeing these, these ads and these TikTok videos or these YouTube shorts or whatever the case might be. And you know that these claims aren't true. As a software engineer, as a technologist, as a trader, and just as a guy with a brain, I know that these claims are largely unfounded, and it's a part of the marketing gimmick to get you to turn over your wallet and to offer your hard-earned money and cash to these folks and to these companies. And I'm here to tell you that although we offer similar services and similar products, our claims are significantly different, right? I will never promise you that our algo portfolio can work on all instruments, all time frames, and that you're never ever going to take a series of losses. It's just not true. I couldn't even sleep at night making certain claims like that, right? So I really want to set and temper certain expectations here by really saying that algos are not a holy grail. Algos are not a one size fits all. Algos are not going to magically print you money every day without any issues. Algos have problems, algos have losing streaks, and you need multiple in order to really maximize growth, maximize the return, and reduce the overall equity portfolio drawdown. So one of the main upsides, if you will, of having multiple algos trading together in a portfolio is that you get to trade multiple assets at the same time. I'm only one person, so one guy, Jay, I can't trade NASDAQ and crude oil and a gold at the same exact time. I'm only one person, one man. I'm usually, looking at one, maybe two screens. I only got two hands. And so as a human, I just cannot trade multiple things at the same time. Each market is made up of a unique set of market participants. Each market has its own, quirks and features to it, and it takes traders years to really get a hold on and wrangle one market, much less, three, four, five, six at the same time. So the reason why you want to trade across a portfolio is that you're allowing a computer to do what you as a human can't do, right? And the whole point and purpose of a computer is to aid humans in computing and solving problems. So the goal of an algo is that one isn't really enough. One is good to get started, one or two might be good to get your feet wet, but at some point you really have to graduate and start to think at the portfolio level. As I always, stress to you guys in my clips, you have to really see yourself as a portfolio manager, and you have to learn to see yourself as your own mini hedge fund. And each algo is an employee of your firm, and he is designed to work for you and follow the rules of your system and the rules of your trading business as a whole. So the more algos you can afford to fit in a portfolio that can trade in a complementary way, the overall better you tend to do when it comes to things like drawdowns and maximizing returns, and just overall having a smoother and more manageable equity curve, right? So how does it work overall? So our first offering is called the ZTA Quant 1 portfolio, and this is a portfolio of 6 algos trading 5 unique markets, right? So we have 6 algos trading across ES and Q, crude oil, gold, and natural gas. And again, the idea here is to help you capitalize and reach across markets and trade multiple things that you as one individual person would not be able to really trade on your own effectively at scale for long amounts of time. Okay, we have done all of the heavy lifting for you already. So we took our time and we coded up each algo, we back tested each algo, we put each algo through our own rigorous 7-step robustness testing procedure. We did all of the correlation analysis, we model out the historical portfolio returns, we calculated how much capital you're going to need, we calculated the maximum drawdown for each strategy and the maximum drawdown for the portfolio as a whole. We have figured out an optimization schedule for each algo. We have done all of the hard, brain-busting, heavy lifting. All of the boring drudge work is already done for you, and all you have to do as the end consumer is buy the portfolio and apply it to your chart or apply it to your strategies tab in NinjaTrader, and you can literally get set up and start trading natural gas in 2 minutes. It's really incredible how far technology has come, and that you as the consumer don't have to concern yourself with all of this upfront research, engineering, coding, software, data science kind of work. All you have to focus on is, hey, I have an account and I'm ready to get set up and start trading these markets, right? So it's really an interesting and streamlined thing we've went ahead and created here, right? As most of you might know so far, we put each of our algos through a rigorous, strict, stringent 7-step process, which usually starts with, first brainstorming an idea or kind of thinking of an idea. We might get ideas and concepts from YouTube channels, from books, from forums, from books from the 70s and 80s, from podcasts. We really try to extract alpha from as many reputable, trusted sources as we possibly can, and then we really just jump into the code and start to actually flesh out a proof of concept, right? And then we get to actually back testing it with historical data to make sure that the strategy idea or concept has some legs. It held up historically across 3, 5, 10 plus years. For me, as a strategy creator, I personally like long back test windows. I've heard other folks say contrary things. I've heard guys say that back tests from 2010 aren't relevant because the market cycles change so frequently, and so he himself only back tests the last 1 to 2 years. I find that to be a cause for concern personally, so I prefer longer back test periods to ensure that I have a strong sample size of trades and that the strategy has just held up historically. I just want to ensure that my strategies have held up across a solid chunk of time historically, and 1, 2, even 3 years isn't really enough for me and my team personally, So moving on through our process, this is steps 1, 2, 3, and step 4 and 5 are really two of my favorites. We put the strategy through what is known as walk forward optimization, and the whole entire goal here behind walk forward optimization, or WFO, is to really see how adaptable a strategy is, right? So let's say that a strategy has an entry trigger that uses an EMA, and let's say it is the 9 EMA for whatever reason. What happens if we change it from the 9 to an 8? Does the strategy, fall apart? Are the returns significantly skewed? What happens as we tweak and change and adjust the inputs of the strategy? How does the strategy as a whole respond to an ever-changing and dynamic market environment? The whole idea here in step 4 is that the strategy should still hold up. It should still work if you change from a 9 EMA to an 8 to a 12 to a 13. It shouldn't all of a sudden fail if you make minor changes to certain parameters or settings values, right? Step 5 is also one of my favorites. It is called the Monte Carlo simulation. And the entire idea here is, if you have an historical backtest of 500 trades, what happens if you shuffle the order of that 500 trades, right? So the sequence of wins and losses are now changed, right? Because you've now shuffled the order of the trades. But what happens to the returns of the strategy? Again, is the strategy falling apart? Is it going from a net profitable strategy to unprofitable? Is the win rate significantly reduced such that the strategy can't be traded really? What happens if you alter or tweak the sequence of events, right? Because how the trades were ordered in history will never repeat again in the future, right? So a Monte Carlo simulation is a great way to model how the strategy will hold up against a different and changing future environment. Step number 6 is we then take the strategy and we incubate it in a sim account for 30 to 60 days. And the goal here is to see if the strategy actually has the potential to extract money from the markets. And even though it's in sim, we want to see that our idea actually has edge, it actually has alpha, and can extract dollars from the market, okay? And then last but not least, my favorite step of all is we deploy every single strategy live, and we trade it live, and we put our actual cash and capital and we test it to see if it can make real money in a real market environment, right? Which might have delays in fills, which might have latency issues, which might have connection issues, and so on and so forth. And so it's really important to test the strategy live and see how it actually does in a real time, real life working environment, right? So our process is it's strong, it's tough, it's stringent, and it's designed to literally fail most of our algos. Most of our ideas fail and don't even pass step 4 or step 5. And so the whole entire goal in having a systemized, well-tested, strict process is to give you confidence in your strategy, trading in the future and trading in a live environment, and putting your hard-earned capital behind it, okay? Now, I wanted to briefly talk about one of the most important items, which is learning how to think in the long term, okay? I can't tell you how many folks come to our comment, how many folks reach out to us on, Twitter or our website chat and ask us one of two of these most common questions. Which one of your algos will help me pass a prop firm challenge in X amount of days? Or which algo can help me make X amount of dollars by Tuesday next week, or some ridiculous thing like this. And I really want to drive home a key point here is that in order for you to succeed in trading in general and specifically in algo trading, long-term trading, portfolio trading, you have to master long-term thinking, and you really have to approach it with a long-term growth mindset. If you're looking to just pass an Apex challenge tomorrow, or you want to pass some combine in 4 days or whatever, you're really doing yourself a disservice by not zooming out and thinking long term. You have to think in terms of months, years, decades, really, in order to maximize returns and truly change the course of your life. And so I really want to invite a specific type of client, a specific type of customer to our website, to our business, because these are the long-term partners who we're going to enjoy working with. Folks who kind of think like us, and folks who kind of share in the long-term thinking approach in a truly futuristic, goal-oriented growth mindset, kind of way. And so anyone who is just looking for a bot to pass a prompt challenge and then get paid out and that's it, we are not really the shop for you. We're really trying to talk to long-term minded folks who are interested or even curious about building an algo portfolio, growing a portfolio, trading across multiple markets, really growing an account over years and years to come. And so if you are more of the short-term thinker, just go ahead and click off this video right now, because we're probably not the right software company for you, okay? And then last but not least, I want to talk to you guys about pricing. So with our yearly portfolio, we have opted for a yearly pricing model. So with the ZTA Quant 1, it will be $9.97 per year. It is a one-time, once per year payment, right? So you're not going to get charged monthly. And if you look at how affordable it is for 6 fully functional, fully testing algos for only $9.97 a year, that is less than $100 a month for a full portfolio. You're trading gold, crude oil, natural gas, ES, and Q. And trust me, we have many more markets coming. We got tons more assets coming, tons more bots, a lot more tools coming your way. We wanted to keep the price affordable, again, keeping the retail trader in mind. So when you really bucks to trade a full portfolio that a hedge fund might trade, you know what I mean? Like an institution might trade a similar portfolio and pay thousands of dollars a month to certain software vendors and licensing and so on and so forth. And so you get access to the same suite of tools for a fraction of the cost. And so I really want to implore you again to zoom out and to think about the long-term approach. This cost here shouldn't scare you. It shouldn't frighten you. And if it does, you're probably not the customer who we're looking for and who we're talking to. So again, we're looking for the long-term minded folks who can, extrapolate out and see themselves in 2 years, in 3 years, in 5 years, fully trading full time and thriving in their trading business as a whole. So pricing should not be a factor for you. The mindset is most important. You have to have a long-term goal to grow your portfolio and really empower yourself as a trader, and removing the emotional, struggles and pitfalls that many of us tend to face in our first few years learning how to trade effectively and profitably, right? We have a nice little tool we built out to, showcase to clients and customers once they have purchased the ZTA Quant 1 portfolio. The idea here is to kind of show them a few of the modeling items we have to showcase, portfolio correlation and just the overall settings and setup of the portfolio and how it has done historically in back tests as a whole and so on. So the first thing you'll see here as you're observing is the main capital requirements and maximum drawdown values of the portfolio itself. And so you can see here that in order to trade the ZTA Quant 1 6 Algo portfolio I just talked you guys through and showed you guys, you need an initial required capital of about $30,000, and the maximum historical drawdown since 2008 has been about $10,000, right? And so if we take a look at the overall equity curve, you can see that the total return across all six algos, right? Again, trading since 2008 until today has netted a portfolio return of over $700,000. How incredible is that? To be precise, let me scroll down here. It has netted a total of $701,000. That is absolutely incredible. And I wanted to actually show you guys a very interesting thing. So, if the initial required capital to start trading the portfolio is only $30,000, right? And we started trading in 2008, January 1st, 2008. What would have happened if we instead put that $30,000 into, let's say, the S&P, and we held it for the same amount of time? What would have happened? So let's take a look here. If we put $30,000 in the S&P in 2008 and we held it until now, the investment would have grown to an estimated $101,000. And if you adjust for inflation, that would be about $70,000 in today's dollars adjusted for inflation. And that return honestly is not horrible. It's not bad. It's a nominal price return of 239%. That's not bad. But this return shows you the power of algorithmic trading, the power of trading a portfolio, right? This is actually $600,000 more, right? So that tells you and shows you the power of trading a diversified algorithmic trading portfolio and just letting the algos do their thing. It is 100% possible to have an edge, to beat the S&P, to beat the market if you have a long-term vision, if you employ a growth mindset, and if you just trust the algos to work as they should, and you let your portfolio do its thing. I mean, I really can't get over that, right? 101,000 versus 701,000. How fascinating is that, right? And this portfolio in particular, I remind you, is only trading six algos. It's not trading 10, it's not 12, it's not 15, it's not 30. It's only six algos across, natural gas, crude oil, gold, ES, and NQ. Absolutely phenomenal returns. Now, I wanted to briefly talk about correlation. So, one of the main pluses or one of the main advantages to trading an algo portfolio is you get to reduce drawdown by way of reducing overall portfolio correlation, right? So, each time you add a new algo to the portfolio, we want to see what happens to the correlation. How is it correlated to the already existing algos in the portfolio, right? Because we don't want to trade too highly correlated systems, right? Because if a few of the algos in your portfolio are too highly correlated, that means that they tend to go in drawdowns around the same time. And as I expressed earlier, our goal is to reduce overall drawdown, right? So you want to trade algos, you want to trade bots, you want to trade systems, excuse me, that have drawdowns at different points in time. And so you can see here that we have very low correlation. And so for those of you who aren't familiar, this is a correlation matrix, and all it does is it calculates how related two or more sets of data are, right? And so the highest correlation value you can have is 1, and the lowest correlation value you can have is -1. And so as you see here, quite a few of our algos are negatively correlated with each other. Absolutely beautiful. Anything below a 0.5 or zero point 0.4 for me is low. And so to see negatives here, it's a beautiful thing. It's a beautiful thing. And so this tells you and showcases to you the power of focusing on lowly correlated multiple strategies, trading together across a diverse range of time frames, strategies, entries, exits, stop losses, and of course, markets overall. But this is just absolutely fantastic right here. So also clarify, these numbers are considering one mini contract per algo. Okay, so if you were trading one mini per algo, these are the amounts of capital you would be required to actually start trading the portfolio. And all of these numbers are measuring against a one contract per algo portfolio. Of course, if you were trading micros, this would be 1/10, and so you can actually trade the same portfolio on micros with a tenth of the capital requirement, right? So it would be $3,000, and the maximum historic drawdown would be $10,000, and of course, also historical portfolio cumulative equity would be $70,000 instead of $700,000, again, because you're trading micros, and it's 1/10 of the value. But this just goes to show, man, that it is possible to beat buy and hold. It is possible to beat the market if you do it in the right way, and if you have a long-term growth mindset. Okay, you had to have let this $30,000 sit and rest and work for you for over 15 years. How many of you can honestly and truthfully say that you could put the capital in an account and just let it work, without touching it, without, you know, going in and want to remove an algo, and you want to turn off the bots on certain days because you slept well and Mercury's in retrograde and you had a fight with your wife, and so now you want to turn off the bots. So it's really important to understand that the long-term growth mindset is required to succeed in this game. Okay.